Today's topic: turn your home into a rental property. 5 tax hacks to save you big. A question that has come up quite a bit. Why has it come up? Well, when your current mortgage is at 3% and the next mortgage is at 7%, all of a sudden, keeping that home as a rental property seems pretty attractive. Am I right? So today, I'm going to walk you through 5 different topics. We're going to go from expense deductions, passive loss rules, selling your home to an S Corp, the infamous 1031 exchange, and one that you may not have heard of that we'll save for the end. But we call it the old 1152. Where do we get that? Well, there's 2 different ones linked to that 1031. There's also one called a 121. What do you get when you do 1031 plus 121? I think I'm good at math. 1152. So 5 fun topics for you to think about. Now listen, these topics are complicated. Not only should you have a fantastic financial planner, you should have a great accountant. You might even need to bring in a real estate attorney on how crazy this might get. But there are landmines and there are gold mines. And the goal is in this video to at least give you some ideas to go back in your next Google search or in these days AI searches, and then also build on those topics within going to your own professional team. But I will give you 5 really cool ideas to think about if this is something you have been pondering with those nice low rates that you have in, or maybe you even have a higher rate, but you just love the home and you want to make it a rental property. So stay tuned. 5 fun tips, tricks, hacks, whatever you want to call them, coming up next. All right, before we get into it, I have a quick little favor to ask. I always plug it at the start now, but if you have not subscribed to the channel, now would be a great time to subscribe to the channel. Click on the bell icon, get a notification every week, when we release a new video like this one. That's it. That's the only pitch. Also, if you're looking for a great financial planner team, hey, WealthKeel is always looking for great clients like you. You can always schedule an icebreaker call right on our website at any time. That is a free intro call. That's it. That's the pitch. Okay, first up, expense deductions. This one I always like to discuss with clients whenever this topic is maybe getting a little bit of warmth to it, starting to heat up a little bit. But one of the most important things to think about is there is a big difference between me going to go paint my entire house now versus we're going to list it to rent and then I go paint the entire house. What's the difference, Chad? Same paint, still went to Lowe's, did all that. The difference is one of those is just a personal expense. There is no benefit to it, right? If I go paint my house tomorrow and it's not listed for rent, that is just a personal expense. Doesn't show up anywhere, right? But if I list my home for sale, right, and then I start to do some of these updates, those become deductible expenses. So if you're sitting there pondering some of these things, just keep that in mind. Now, for the big stuff, right, if you go to fix the AC unit, that's one thing. That's an expense that you can deduct in terms of it's listed as a rental. Now, if you go replace the entire unit, right, there's still depreciation schedules you have to follow. But if you're sitting here watching this video and you're thinking, you know what? I like my 3% rate, and maybe I will keep this as my first rental property. Right? We know in the physician community, very popular topic. It's died down a little bit because when rates are higher, you don't have as much leverage in terms of your cash flow. So if you're doing a more traditional 20% down, but rates are higher, it likely eats up a lot of your cash flow. You add a property manager, all of a sudden, you're cash flow neutral, maybe cash flow negative a little bit. But if you have a home now and you were able to lock in some of those much lower rates that we had, just a few years ago at this point, this could be a potential, we'll call it more of a gold mine than a landmine, right? But if this is an option and you have expenses on the horizon, remember that there is a dramatic difference based on the timing. If you just go do it tomorrow and it's still just your personal residence, no big benefit. But if you do list the home, right, and you're making this a rental property, those become deductible expenses. So number 1 on the list is if you were pondering the idea of making your home into a rental property and you have some expenses coming up, if you can delay those until it becomes a rental property, you will get a lot better tax benefit for putting in that small pause. So that's tip number 1, or tax hack number 1, we'll call it, for today's video. All right, another important topic for you to consider if you were going to go down this road. This also comes up in just all real estate conversations, but For most of you watching this video, again, I'm assuming most of my audience is still physicians. I know we get a good amount of lawyers and dentists and vets in there as well. But regardless, all of you would be labeled as what I would say high income professionals. So this one is not as attractive, but it's still attractive. Let's just say in year one of your rental property, you're doing all those home updates we just described, right? But you don't have tenants, right? You're probably cash flow negative here at the start. And that's not uncommon. But we label this as a passive loss. Now, there's special rules in place for passive loss rules. Now, I'm going to note over here just to kind of give you the numbers. If your income is below 100,000 and you actively participate, which I won't nerd out on that, but that's not that hard to do. You'll be able to deduct those against your regular income up to 25,000. That is a huge win, right? That's actually deducting expenses from the home, right? The actual loss throughout there against your ordinary income. We would label that as tax arbitrage. But again, don't get too excited because your income has to be below 100,000 and essentially phases out from 100,000 to 150,000. Again, most of you watching this are likely above those income thresholds. Now, if you're sitting here, right, and you maybe have a sabbatical coming up or income has dropped for whatever reason, maybe you can time this appropriately. But this is one of those ones, when our physicians are always thinking, how can I offset my ordinary income? And we get into like real estate professional status and things of that nature. That's one of the big wins here, right? We're trying to actually offset all of those numbers, the depreciation, the expenses, all of that to offset your ordinary income, which I always label as tax arbitrage. Now, don't worry. If your income is above that number, you're not losing this, right? They just carry forward. So this is an important topic. If this is, you're just dipping your toe in now, I was going to try to show you dipping my toe in. That's probably not going to work well for this, but I actually did the physical movement of dipping my toe. If you're going to dip your toe into it, this is a very important topic for you to understand, important topic to talk through with your financial planner, your accountant. These are ones that, when we look through our client's Schedule E every year, we like to kind of describe this and what it means. But for a lot of you, if your income is past 150, you're completely phased out. If you're below 100, this is a super sexy option if you can get it to work. But remember, the passive losses cannot offset ordinary income. If your income is too high, you do not lose them. They will carry forward, but just keep that in mind. So that's number 2 on the list is our passive loss rules. All right, third on the list. This one is one of the more nerdy ones in there. I would actually say this is probably the most nerdy option in there, even though the 1031 and the 1152 are also pretty nerdy, but this one's has some moving parts to it. So this is when you can sell your home to an S Corp. Now you're thinking, why would I sell it to an S Corp? Well, the good news is if you do this right, you own the S Corp. So yes, you're selling it to yourself, but you're selling it to the S Corp that's owned by you. A lot of moving parts here. Good accountant, maybe even a good real estate attorney is going to be vital here. But why would we do this? Well, remember that there's an exchange. There's a number, an exclusion. I shouldn't say exchange. The exclusion number is this. The current tax code says this. If you are single and you have up to $250,000 of gains, it's excluded. Right? So what does that mean? Let's just say you bought a home. I'm going to use easy numbers here for $500,000. You then sell it for $750,000. A lot of people still do not know about this exclusion until they go down the rabbit hole and they find out, wow, this is amazing. But that $250,000 of gains from what you paid to what the actual sell price was, right? 500 versus 750. The $250,000 is excludable, right? It's an exclusion in there. It's part of the current tax code. If you're married, that actually jumps up. It jumps up to 500,000. So same example, bought it for 500, just heated up a little bit more, got up to $1 million. You don't pay capital gains tax on that 500,000. So that's why it's very attractive. Now, with the S Corp sale rule, this would be one of those examples where maybe you're not fully ready to sell it outright, but you want the exclusion. This would give you a chance to still take advantage of that exclusion by selling it to your own S Corp. Now, like I said, this is not something you just go out and wing it. You need a deep bench for this one. But those are that's one of the more popular options to take a look at, because if you're not fully ready to sell yet, it gives you a chance to sell, but you're selling it to yourself and still locking in that exclusion. Whether it's the lower rates you have just in that lower rate environment that we just had, or you do want to lock in some of these exclusions before they would if they would ever go anywhere, this would give you a really good chance to do that. But again, this is complicated. There are moving parts to it. The goal of today's video is to give you some fantastic ideas. You have to dig a little bit deeper and then talk with your professional team to put these in play. But this is a cool one, and one that most may not know about, but we call it the S Corp sale, and that is a way to lock in your exclusion amount. All right, next up on the list, probably one of the most popular topics in terms of the rental real estate world. We call it the 1031 exchange. Not the same as a 1035 exchange, which is more common in like the investment vehicles. Think like annuities, life insurance. This is a 1031, 1031 exchange. So the unique part with it, the one thing I haven't noted is, there's a lot of 3-year rules in place here, but let's just say that you convert your home. You'd want to do this with a rental property, right? So you're converting your primary residence to a rental property. You don't want to do a 1031. You can't do a 1031 with primary residence. We also call it apples to apples, right? You got to make sure you're doing the apples to apples option here. So you're going from a rental property to a rental property is what I say. You can't go from like a rental to a primary residence, primary to rental, those types of things. Apples to apples, not apples to oranges. So what is a 1031 exchange? For those of you who are not used to this topic, it essentially allows you to defer all the gains, right? You bought it for $1 million, it's worth $4 million. You can defer $3 million. You're not paying any taxes. You're deferring them. You're moving it from one property to the next. One I wouldn't say joke, but one thing I say quite a bit is, if you really want to build up a real estate empire, you want to buy a property, force appreciation, whether you're doing upgrades, improving the rent, take the new value of that, 1031 into another property, ideally a larger property, and you kind of keep working your way upstream, right? Keep going up, keep going up. And before you know it, you have a juggernaut. We don't have any clients that have personally done this, but there are stories out there, especially in the physician community, of where, they started with a single row home and now they own, a not only a multi-unit. I mean, there are like condominiums where they have like 30, 50, 100 units now because they just kept doing this year after year. Now, this is something you're not going to do like overnight, right? You got to build it up. But with that 1035 exchange, or excuse me, 1031 exchange, you are essentially going to continue to work your way upstream. You don't have to do that, but you are not going to have to pay capital gains. So that's the beauty when you're doing this properly, right? When you're doing this properly, remember, landmines, gold mines. Let me tell you about a landmine inside of 1031 exchanges. There are strict timing requirements. You have to identify a property in 45 days. You have to close in 180 days. Now, let me give you a fun little tidbit here. When you do a 1031 exchange and you're going to identify a property, usually you can list 3 properties. I would highly suggest that you list something called a Delaware Statutory Trust, or a DST, as one of your options. It is your get out of jail free card. Because if you can't find a property and you are time crunched here, by going to a Delaware statutory trust, there's a few different ways that you can set those up too, whether it's a larger fund that will buy that property, whether they're going to essentially have you sell that property and the funds roll in. There's a few different ways to do it. Again, remember, deep bench, good financial advisor, good accountant, maybe a real estate attorney in there as well. But the 1031 exchange can be a really, really unique benefit in terms of not only deferring capital gains, but also giving your future children, whoever's going to get it. I'm thinking kids just in my situation, but whoever would get it, because remember, you keep pushing it down the line, and let's just say all the tax laws stay the same, they get a step up in basis at death. So you could keep doing this forever. And let's just say you started at $250,000, but now you're up to like $10 million of real estate. You pass away, boom, they get a step up in basis. So they could go sell the whole thing tomorrow and essentially be, free of taxes. So 1031 exchanges are great tools for numerous reasons. But remember, gold mine, certainly. Landmine could go horribly wrong if you're not doing that properly in terms of the 45-day rule, 180-day rule. Don't forget about the DST, a Delaware Statutory Trust. Thank me later if you ever use that. You'll be very happy that you watched this YouTube video. So what are we on here? We're number 4 on the list. Keep an eye on that 1031 exchange. Remember, it's already a rental at this point. Now we're deferring after the fact, right? 1031 exchange. All right. Last but certainly not least, the 1152 plan. And again, how do you get an 1152 plan? Well, we just went over the 1031. That's a huge part of it. The 1031 is a huge part of what we call the 1152 plan. The other one is in there. It's called a 121. They call it a 121 plan. I don't even know what they actually call it. Regardless, you put the two together, you get the 1152. So it just builds on the 1031. But what could happen here is the 121 part of it will allow you to pull out the exclusion amount, right? So you can pull out some cash out. You can get some money out of this 1031 and still fall within those exclusion rules. So 250 single, 500 married, at least at the time that we're recording this video, right? So if you had, let's go back to the $4 million example. Hopefully I get these numbers right. So you bought a home for $1 million. It's now worth $4 million. You're going to do this 1152. Let's say you're married. All right, let's write these numbers down. What did I say? 4 million, 1 million. Married, you can pull out 500,000, right? So what's that get us up to? 1.5. So we got 2.5, right? So in this example, you had $1 million home. It's now worth 4 million. You're going to pull out your 500,000 for the exclusion, right? You get to pull that out. You still have $2.5 million in taxable gains. You're thinking, well, shoot, Chad, that stinks. 1031, my friend, 1031 the rest to the new property. And that's how you get the 1152. Still got to follow the rules, right? Especially if we go back to that 1031, all those rules are in play. 45-day rule, 180-day rule, apples to apples, all of that's in play. But the 1152 plan will give you an opportunity on this is best for clearly a highly appreciated property, right? Very appreciated, enough that you can pull out the full exclusion and you still want to roll over some funds. For the bulk of individuals, now we have had some pretty hot housing markets. A lot of you will still fall pretty close to that exclusion amount. I say that, but it really depends, right? We've seen some literally residents in St. Pete, Florida area, where they bought a home for $250 and it's worth $750 now, and they're single and they're well over that number. Or we've had others that have been in hot markets and they're still within that range. So it will vary, but the 1152 makes the most sense for those of you that have had pretty substantial gains, enough that you have to pull out the exclusion and then still have a good amount left over for that 1031 exchange. So fantastic topic, a topic that continues to come up. My golden rule, whenever we start to see a topic over and over again, or we hear clients asking about it, this is one that we've had clients asking about it because they have those low rates. Again, physician community, we hear the word passive income, we get excited, so we think rental property. So a very popular topic, but 5 really neat things for you to keep in mind. Like I said, keep it at high level here, as I usually do with our YouTube videos. Ideally, I want you to dig into it more with your professional team, but I at least want to give you some ideas, some neat things, maybe things you've not heard about, whether that's the 1152 or even the S Corp sale. That's another unique one in there. So turning your home into a rental property, 5 tax hacks to save big. I think I'm going to use that line a lot more. I do like the idea of landmines and gold mines, especially in the world of personal finance. There are a lot of gold mines out there, whether that's on the financial planning side, the tax side of it, the estate planning side, the insurance side. But if you're not doing it the correct way, following the right steps, those can easily turn into landmines as well. So if you have questions, if you want us to dig deeper into some of these topics, drop us some comments below. You'll see through all of our YouTube videos. I love getting back to all of you as quickly as possible and answering your questions, and also taking your questions and building even more content. So thank you for hanging out with me for the last maybe a little bit over 15 minutes or so on this one. But again, a fun topic. And as always, I will catch you on the next video.